Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Johnson & Johnson stock, ticker JNJ. This came in by request down in the comment section of one of my other videos by a couple different people. And so I'm going to make it an analysis video here for everybody. If you have a request of a stock you would like me to analyze, just put it down in the comments. I'll get the ticker on the whiteboard behind me, and eventually I'll make a video. If it's a stock that's in the S&P 500 like Johnson & Johnson is, I post those on YouTube for free, and the rest I post on Patreon, which is $5 a month, and in the full Cyclical Investors Club service over on Seeking Alpha. Those links will be down in the description. If you join the Patreon group, you could get a big discount if you ever decide to join the full Cyclical Investors Club service. And there's also a free tier for the Patreon right now. And I'm going to be adding more and more things over there for the free folks over at Patreon as well, including all these videos that I make here. But I'm still working on some of that. So go ahead and join and then just be patient and see what I come up with for everybody. Okay, so as always, this is not individual investing advice. This is just how I analyze stocks. Johnson & Johnson's pretty interesting. For a long time, it really always traded about the same as like the S&P 500. So you could almost look at Johnson & Johnson because they were so diversified and their earnings were so steady. As you can see, this dark green area on the fast graph, it represents their earnings over time. That they were very steady earning, kind of boring, you know. But then we got into some of these baby powder lawsuits and COVID and a few other things. And things got a little bit more interesting lately. So let's start by just, as usual, I like to look at the pattern of earnings, but we already can see that other than this COVID year, earnings per share have just steadily kind of risen, not super fast, not super slowly. You know, over the past 20 years, if you just go point to point, Fast Graphs is looking at 6.5% earnings growth rate. So not super exciting. But if we zoom into, I'm going to use a time frame from usually kind of 2015 is what I've been using for most stocks lately. Starting in 2015, we can see that the actual return, you know, if you just started like pre-COVID here through today, is, we'll call it flat. With the dividend, you get a couple percent a year, which is what inflation basically, maybe not even quite inflation. So it's really stagnated the past 4+ years, we'll call it, while the rest of the market is up significantly since then. So, and earnings generally, if you look at the earnings per share, they are higher than they were back then. So if we just look at the PE maybe really quick. So we have a 17.5 PE, almost 18. Now we're below 15, right? So you can see why. And then if you look at the forward PE, it's probably, this is a blended PE. If you look at which takes some of the earnings from before and looks forward at like a quarter or two. But if you look all the way forward here, the PE is probably even lower. So you can see why it might look attractive or more attractive than it has in the past for investors, right? So that's kind of the setup here. Now there are a few other things to consider. So first let's talk about like the lawsuits. When I first saw these like pop up, I thought that they were really stupid, but when I looked a little bit more at it, I could see where there might be a little bit of liability in some cases for Johnson & Johnson. But I think much like we saw with the recent settlement that, you know, and just the way the United States is structured, where businesses have a lot of advantages, even if they are guilty of something, usually they're not going to ever get put out of business by lawsuits unless it's something like really horrible. And I don't think that's the case here. So for me, you're going to see these billions of getting taken down to millions or tens of millions maybe in terms of the cost of that. And I think that's kind of what investors should expect, but it will probably be a very long and drawn out process. So that's kind of my take on that. How to price any of that. I mean, I don't really know what's fair to price it at, but it wouldn't keep me completely out of the stock. We'll put it that way. They also recently had a spinoff of, what is it, KView? I'm not sure what the actual, maybe I'll look at. Someone asked me about it already. I think it was the same view, yeah, KenView, sorry, that asked me about Johnson & Johnson. So my quick take, and I'm not an expert, I haven't looked deeply into it, is probably in this case they spun that off because they thought they could get more money from the market in the short term, then maybe it would be worth them trying to manage in the long term. There's always, they'll give their pitch about why. But for me, they probably did it so they could try to find more growth. They could raise cash. That looks like what they're doing anyway. So I think for the Johnson & Johnson part of that deal, that seems good to me. Like, that seems like that was probably a smart thing for them to do, because we know now that they went and bought Shockwave, or it hasn't closed yet, but it looks like it's going to be some sort of deal unless somebody else comes in with more money. So interestingly, and I know the person that asked me this did not know that I own Shockwave and that we own it in the Cyclical Investors Club for like the past 7 months, I would say. So that's getting bought out at, like, from when we bought Shockwave, about a 53% premium or something like that. So on one hand, that's good, it's nice to make 50% in 7 months. But on the other hand, the reason I bought Shockwave for my fast long-term growth strategy is because I wanted to hold it for like 10 years and hopefully get like a 5x, or a 10x or something like that. And now I suppose on an annualized, decadized basis, I got my 5x if I get 50% in 7 months. But then I would have to be able to go out and find some place to put that money that's going to have the same odds, right? So it's a bit of a double-edged sword, but, I'll take profits whenever I can get them. And it's good to know that my process is similar to the folks at Johnson & Johnson, who can see the longer-term value there for them, right? So, and I've had this happen several other times with stocks that we bought, where we buy them when they're a good deal, and then eventually other people notice it and get bought out. I think even on the YouTube channel, we had one bank that got bought out within like 3 weeks of me posting the video. So, bought out at a premium. So, I think it's a good deal for Johnson & Johnson, probably. I mean, I expected Shockwave to do really well over the next 5 or 10 years. And if it does how I was thinking they could do, Johnson & Johnson's getting a great deal. And so that's I view that as bullish, when I'm ready to, I have another company, I forget what it was. I think whoever Cisco bought, I forget. It was right on the borderline of us buying it, and Cisco came in and bought it. And again, like, it's good because it lets you know that my process is good because other people are seeing the same thing. But at the same time, it would have been better if I was able to buy it and then not get bought out, So I think Johnson & Johnson is probably doing like the right things, generally speaking. But none of it, I mean, Shockwave is small. I think they're paying $13 billion. They made another acquisition too, but I forgot what it was a while back. So, I mean, $13 billion on a $360 billion, or $13 billion on $360 billion is pretty small, 3% or 2% or something of the current market cap. But if the 2% 5x's, then it's up to 10%. And, now if the rest of the business is slowing or shrinking, right, you can see how that over time works to their benefit. So, and you can also see that, management seems to be finding, like, to me anyway, they're finding a good deal, right? So if they can find one good deal, maybe they can find more good deals. And so that gives you a little confidence that maybe they can get some growth going. Okay, so with all that context in mind, one thing I do want to say that I noticed is, you notice earnings per share went from like $9.92 this year, which was a decline off the previous year, and they're expected to go all the way up to $10.65. Well, it looks to me as though they took some of that money that they got from the spinoff and they bought back a lot of their own shares. So what that does is that inflates this number right here, and I don't really think without that the earnings per share would have, and this hasn't happened yet, so it could be worse or better, we don't know, but it's inflated. So I adjust for that with my when I adjust for my earnings, when I make my earnings growth estimate. And so I want to show, I don't know what FastGraphs is going to say. So FastGraphs says at 6% earnings growth during this time. And because I make that adjustment, let's go in there, I'm at like 4.6. So I'm a little bit more conservative. 4.6 is still pretty good. And if they do get the growth from some of these acquisitions over the next few years, this could actually be better, right? Because they're kind of getting rid of slower growing stuff and they're buying faster growing stuff. And so hopefully this would improve. I'm very biased toward history, and I'm more conservative when it comes to my assumptions. So I'm not just going to make up a number like a lot of people would. They'd say, do the Shockwave calculations, do the whatever, maybe it was Biomed or I forget exactly who they bought, but they would maybe try to do that and forecast it out. Like I don't bother with any of that. I'll just be conservative, and if I get lucky, the stock will trade down to the levels I want. So I assume a 4.66% earnings growth rate from here. That adjusts for this little dip in earnings here, which immediately recovered, so it's not much of an adjustment. If I would have just pulled this out, I probably would have had the same growth rate. And then they bought back about 13% of the company since 2015, including these recent purchases. So those two things I adjust for, but I do assume that they will hit these numbers and pull those forward when I start my calculation here. So the way I like to think about this is, I do also, they don't have much debt, it doesn't look like, so that's not much of a factor. Let's see. So the way I do this is I assume that if I paid $100 for the company, how much earnings would it pay me back, and how much would those earnings grow each year? And then what I want to know is how much I would collect on my $100 investment after 10 years. So they would have a 6.67% earnings yield, which is going to be very low teens PE ratio. And this would grow at the 4.66% each year. So I start with my $100 and I pull forward the first year's growth of 4.6%. So first year I would have $106.98. And each year that $6 that I'd be earning would grow at the 4.66%, right? So I compound that, or collect that and compound the growth. And then I would end up with $186 after 10 years, starting out with 100. So if you put that in a CAGR calculator, it comes out to about 6.42% CAGR, 10-year CAGR. That's the expectation from earnings, okay? The market right now is actually more expensive than this. It's more like 5.5% expected CAGR over 10 years. So relative to the market, if you don't assume any horrible things going to happen with the lawsuits, to me, Johnson & Johnson looks like a better deal than the average stock in the market. Now, in terms of absolute valuation rather than the relative valuation, 6.5% is what I would call fair value. So it's basically trading at fair value if we just ignore whatever everything else in the market is doing. So I think it's trading at fair value here using relatively conservative assumptions. And my buy level is like 8% 10-year CAGR expectation. So that in normal times would be about $113 a share, about 25% lower. If you think there's going to be a recession, Johnson & Johnson stock usually holds up really well during recessions anyway, so there's not much difference between these. It's only like $5 or 4.5% lower. So with a margin of safety, to try to get some better returns, that 113 under 114 level, about 25% lower here, would be where I would step in and buy the stock. And that goes the same whether there's recession risk really or not. So even maybe if the earnings came in weaker than expected and this fell to, that would affect this number right here. Maybe it falls to like $100 per share. You could go over and use, this number will stay constant. So probably it's unlikely that I wouldn't buy if it got down to like 108. Unless something really crazy happened, obviously. So that's my take on Johnson & Johnson. If you found the fast graphs, if you thought it looked interesting or useful, I have a 25% off affiliate link down in the description as well. If you're a new member, I don't think it works if you already have a fast graphs subscription. And like I said, I have the free Patreon tier, so consider clicking that link down there. And I'm going to have some new stuff and some pretty cool stuff, I think, over the next, say, 6 months that I'm going to build out there. And other than that, hit the subscribe button if you want more videos, and I'll see everybody later.